the most accurate pulse of the American economy isn't the Dow Jones, but the daily traffic at your local McDonald's. And what if that pulse is sending out a dire warning that most of Wall Street and Washington are completely ignoring? In the complex theater of the American economy, the most telling indicators of foundational health often do not come from the pristine reports of Wall Street analysts or the polished messaging of political incumbents. Instead, they emerge from the mundane, everyday transactions of the average citizen. Today, the most potent red flag, signaling a deep and structural fracture in the nation's economic well being, is not waving from the floor of the New York Stock Exchange, but from the glowing menu boards of its fast food drive throughs. At the center of this warning is McDonald's, the long standing bellwether of American consumerism. The company's recent performance is revealing an uncomfortable truth. The economy is not experiencing a unified recovery, but rather a K shaped bifurcation where a high flying minority prospers while the working class majority is collapsing. This is not just a story about hamburgers, it is the story of an economy on the brink, masked by statistical illusions that are rapidly colliding with a painful ground level reality. The best place to start is with that McDonald's warning. It really paints a clear picture of this split, this bifurcated consumer, and the total end of what we used to think of as value. The narrative of economic bifurcation, a stark divergence in fortunes, found its most compelling evidence in the third quarter earnings report from McDonald's. On the surface, the figures presented a veneer of stability, even success. The company reported a global same store sales increase of 3.6%, with a 2.5% rise in the United States. In a volatile market, such numbers might be interpreted as a sign of resilience, a testament to the brand's enduring appeal. However, this headline win was not just an illusion, it was a deception. A deeper dive into the earnings call revealed that this growth was not fueled by a surge in customer traffic or renewed enthusiasm for the brand. It was driven almost entirely by one factor: higher prices. The company's growth in average check size was not a metric of popularity, but a metric of price hiking, a sign that the company was extracting more revenue from fewer, or at least financially different, customers. This was not sustainable growth. It was a desperate grasp for revenue in a shrinking market. The true unvarnished story lay in the company's own internal analysis of its customer base. Management described what they termed a bifurcated customer base, a clinical phrase that perfectly encapsulates the K shaped recession playing out in real time. This bifurcation revealed a stark and alarming economic split. The first and most devastating finding was the collapse of the low income consumer. This demographic, defined as those earning under $45,000 per year, has historically been the backbone of the fast food industry. They were the loyalists, the high frequency visitors who relied on the brand for affordable, convenient meals. According to the earnings call, traffic from this group cratered, falling by a staggering nearly double digits. This was not a minor blip or a seasonal fluctuation. The company admitted this devastating trend has persisted uninterrupted for 2 straight years. The implications of this are profound. The traditional McDonald's customer is not just cutting back, they are vanishing. They have been so thoroughly squeezed by inflation and stagnant wages that they can no longer afford what was once considered the cheapest, most accessible food option available. The second prong of the K explains how McDonald's managed to keep its headline sales numbers afloat while the working class was forced out. Traffic from high income consumers increased by nearly double digits. This data point is just as revealing as the low income collapse. The wealthy are not suddenly developing a newfound passion for Big Macs. They are trading down. This is a defensive maneuver. Consumers who just 2 years ago might have frequented fast casual establishments like Panera or Chipotle are now retreating to McDonald's to save money. The high income customer is not visiting McDonald's out of aspiration, but out of a newfound reluctant frugality. This is the K shape in brutal action. The high end of the economy is feeling just enough pressure to trade down, while the low end has fallen off the ladder entirely, forced to turn to even cheaper grocery store staples. The company is, in effect, swapping its loyal base for a fickle, higher income clientele who only there because their preferred options have also become too expensive. McDonald's is no longer the great American equalizer. It is a clear reflection of its inequality. This consumer collapse is rooted in a dual crisis of affordability and quality, a complete erosion of the brand's core value proposition. For decades, the implicit promise of McDonald's was that anyone, regardless of income, could afford a hot meal. That promise is now broken, shattered by what consumers describe as bonkers prices and extreme sticker shock. The anecdotal evidence, which aligns perfectly with the company's data, is damning. Consumers report meals costing $15 to $20, a price point that moves fast food from the realm of value into that of a mid tier restaurant. Specific examples are even more absurd. One customer reported a single egg McMuffin sandwich, not a meal, just the sandwich, costing $8.29. Another cited a standard breakfast meal ringing up at $12. These prices are not just high, they are a betrayal of the brand's identity. They stand in laughable contrast to the collective memory of 59-cent hamburgers and $1.99 20-piece nugget deals. Compounding this sticker shock is a perceived decline in quality, adding insult to financial injury. Consumers are acutely aware that they are paying more for less. There is a widespread sentiment that in response to the inflation crisis, the quality of ingredients has plummeted. Reports of cheaper oils, which alter the taste of the iconic fries, and lower grade, cheaper meats are rampant. This combination is toxic. The consumer is being asked to pay a premium price for a product they feel is now inferior. When the price is no longer a bargain and the quality is suspect, the value proposition ceases to exist. At this point, the cheapest and most logical alternative for the squeezed consumer is simply to opt out entirely and pack a snack or meal from home. McDonald's strategic responses to this crisis reveal a company caught in a state of confusion, aware of the problem, but seemingly incapable of solving it. Its actions are contradictory, simultaneously trying to appease two different warring demographics. On the one hand, the company has heavily promoted the return of its value meals, such as the $5 sausage, egg, and cheese McGriddle meal. This is a clear, almost desperate nod to the affordability crisis, an attempt to signal to their lost low income base that they are still a viable option. However, even this strategy is riddled with inconsistency. Other value deals, such as an $8 10-piece McNugget meal, are seen by consumers as anything but a value, further highlighting the disconnect between corporate pricing and ground level reality. On the other hand, the company is diverting resources toward new gimmicks designed to appeal to the very high income customers who are only trading down temporarily. The company is currently testing crafted sodas and refreshers, such as a new strawberry watermelon drink in 500 stores. The stated goal is to drive traffic during lull periods, such as the mid afternoon. This strategy is a transparent attempt to imitate Starbucks and its lucrative high margin craft beverage business. This move is being roundly criticized as a sign of brand staleness and an identity crisis. The word crafted feels utterly alien to the McDonald's brand, which was built on speed, consistency, and affordability, not artisanal pretense. This dual strategy is fundamentally at war with itself. It is trying to lure back a price sensitive base with $5 deals while simultaneously trying to build a high margin Starbucks like beverage business to capture the high income trade down customer. The company cannot be both a bargain bastion and a craft cafe. This fumbling, contradictory response is a sign of a brand that has lost its way because it has lost its core customer. But this isn't just a McDonald's problem. That's the real kicker. We're getting broader industry confirmation that this slowdown is absolutely widespread. McDonald's is not an isolated case. It is merely the most visible bellwether for a sickness that has infected the entire consumer economy. The K shaped fracture it revealed is being confirmed by nearly every one of its competitors, signaling that the consumer slowdown is broad, deep, and accelerating. From fast food rivals to consumer packaged goods, the message is uniform. The low income consumer is gone, and the middle is barely hanging on. The most dramatic confirmation comes from McDonald's rival Wendy's, which appears to be in a state of recessionary deja vu. While McDonald's is seeing its customer base collapse, Wendy's is facing a corporate level crisis that is forcing it to contract. The company quietly confirmed that it will close hundreds of its United States locations, a mid single digit percentage of its approximately 6,000 domestic restaurants over the next few months. This is not a routine optimization, it is a significant retreat. This new wave of closures comes directly on the heels of the 250 locations it already shuttered in 2024. This is an acceleration of decline. The company's own explanation for this move is a direct echo of the McDonald's earnings call. Management stated these locations are non performing and are a drag on franchise finances, explicitly noting that they expect their low income consumers to remain pressed. The financial data supports this grim picture, with both revenue down 2% and net income down 6%, falling. What makes the Wendy's situation a particularly ominous indicator is its striking historical parallel. Analysts have noted that Wendy's current stock chart performance is tracking with alarming similarity to its precipitous decline just before the 2007 and 2008 global financial crisis. This is not just a bad quarter, it is a pattern of behavior seen only at the precipice of a major economic downturn. The fact that the same company is exhibiting the same signs of distress as it did just before the last Great Recession is a powerful, tangible indicator that the current economic environment is far more fragile than official narratives suggest. Zooming out from the fast food sector, the weakness is systemic. Other major consumer brands are all singing the same funereal song. Cadbury, the confectionery giant, has reported consumers cutting back. Coca Cola, perhaps the most iconic staple in the world, is seeing similar trends. Chipotle, the fast casual darling that McDonald's trade down customers are fleeing, has also warned of consumer pullback. The problem is not contained to discretionary wants, it is now hitting needs. The consumer staples sector, which should be a defensive stronghold in uncertain times, is performing abysmally. In a recent period, 32 of the 37 stocks in the Consumer Staples Index were in the red, with only one up more than 1%. This is not the sign of a healthy, rotating market. It is the sign of a rolling recession, where the pain is so deep that consumers are cutting back on basic, essential goods. The broader retail market confirms this trend. The retail SPDR XRT, an exchange traded fund that tracks the retail sector, was recently down 6% in just the last month, a significant drop that signals broad based investor pessimism. There are, of course, compounding factors. The meteoric rise of GLP-1 weight loss drugs like Ozempic and Monjaro is cited as a potential new variable, possibly contributing to a reduction in overall food consumption. While this may be a contributing factor, it is a convenient distraction from the primary overwhelming cause. Consumers are not just eating less because of a new drug, they are spending less because they are broke. The warnings from McDonald's, Wendy's, Coca Cola, and the entire retail sector are not isolated data points. They are a chorus, and they are all singing that the American consumer, the engine of the global economy, is running out of fuel. And all this points to a massive macroeconomic disconnect. We're seeing a gap between the official data illusions and the ground level reality that people are facing every single. This dire ground level reality stands in shocking contrast to the official narratives being crafted by political leaders and financial institutions. The American economy is now a tale of two realities. The first is the one described by headlines, government reports, and politicians, a reality of strong growth, robust labor markets, and a resilient consumer. The second is the one being lived by the mom and pop households of America, a reality of crippling debt, sticker shock at the grocery store, and the constant grinding fear of financial ruin. The warnings from the fast food sector are the bridge between these two worlds, exposing the official narrative as a dangerous, tone deaf illusion. The political messaging in particular has become a source of intense cognitive dissonance. The public is being told that the economy is the strongest it's ever been and that costs are way down. Claims that gasoline is going to be hitting $2 are made, even as families struggle with persistently high prices for everything else. This narrative dismisses the lived experience of millions. Worse, it frames their pain as a perception issue. When polls show overwhelming economic anxiety, the response is that the polls are fake and that negative sentiment is a con job manufactured by political opponents. This is not just a communications failure, it is a profound betrayal. It is an invalidation of the real, tangible struggles of the populace. The mom and pop reality is one of financial desperation. While official reports focus on aggregate wealth, the bottom half of the economy is disintegrating. Evictions and foreclosures are rising at an alarming rate, a clear sign that the post pandemic support systems are gone and families are losing their homes. Food banks are reporting demand not seen since the depths of the Great Recession, with one entity in Texas alone reporting the need to serve 4 million meals. This is not perception, this is starvation. And the only thing trickling down to the average American is not wealth, but new and more creative mechanisms for forever debt. This isn't the aspirational debt of a 30-year mortgage. This is survival debt. We see this in the all time highs in credit card balances, which are not being driven by a boom in luxury spending, but by a surge in families putting groceries and utility bills on their Visa. This is the most expensive money one can borrow, often at interest rates well over 20%. The ultimate canary in the coal mine is the delinquency rate. For the first time in recent memory, we are seeing a frightening, sustained climb in credit card defaults. This is the last bill people stop paying. When the credit card goes delinquent, it means the tank is truly, completely empty. For the generation that was supposed to inherit the economy, the trap is even more insidious. The rise of buy now, pay later BNPL services, which are now seeing their own rising wave of delinquencies, has saddled young people with debt for the most basic purchases. These services were marketed as convenience, a modern, frictionless twist on layaway. In reality, they are a form of digitized subprime lending for items that should be bought with cash. When a consumer has to finance a $40 pizza or a pair of sneakers in 4 installments, it is not a sign of a strong economy. It is a sign of a generation with zero liquidity. The historic default rates on student loans, which have resumed after a long pause, are just another anchor crippling a generation before they can even begin to build wealth. This desperation is perhaps most visible in the auto loan market, a perfect microcosm of the K shaped disaster. We see headlines celebrating the resilience of auto sales, but the reality is a market that has split in two. On the high end, affluent buyers are taking on $1,000 a month payments for new loaded trucks and SUVs, pushing the average new car payment to well over $700. On the low end, the subprime auto loan market is collapsing. Repossessions are climbing back toward crisis levels. Lenders are tightening standards, not because the economy is good, but because they are terrified. A family's car is their lifeline, it's how they get to work. When they default on that, it's a sign of a household making impossible choices. Do I pay the car note or the rent or buy food? This is the mom and pop reality. This is the brutal mathematical truth of an economy where wages have been decoupled from the cost of living for decades. It is not perception, it is not a con job. It is the logical, unavoidable outcome of a system that has replaced savings with debt and careers with gig work. This is the reality that surfaces when the post pandemic support systems, the stimulus checks, the eviction moratoriums, the student loan forbearance are stripped away, revealing the deep structural rot that was festering underneath all along. Nowhere is this disconnect between political solutions and real world pain more evident than in the housing crisis. With mortgage rates high and prices remaining stubbornly out of reach, the solution being floated is not a policy to increase supply or improve wages, but the creation of a 50-year mortgage. This proposal was met with outrage, seen not as a lifeline, but as a life sentence. It is a tacit admission that the American dream of home ownership is so broken that the only way to make it affordable is to condemn a family to 2 generations of unceasing payments. It is the ultimate betrayal, a prolonging of debt that benefits banks while chaining households to a lifetime of financial servitude. This chasm between illusion and reality extends deep into the macroeconomic data, where positive headlines consistently mask underlying weakness. The labor market is a prime example. A recent ADP report was celebrated for its rebound, showing a headline gain of 42,000 private sector jobs. While presented as good news, this number is, in reality, a sign of profound deceleration. Most economists agree that the economy needs to create approximately 150,000 jobs per month just to stay, even with population growth and labor force entries. A print of 42,000 is not growth, it is a significant net loss in real terms. But the true story, hidden beneath the headline, was even worse. The report's own details showed that small and mid sized businesses, SMBs, the true engine of American job creation, actually shed 40,000 jobs. This marked the third straight month of layoffs for that critical sector. The rebound was a statistical illusion, a rounding error in large enterprise, hiring that completely papered over the fact that the backbone of the economy is breaking. This weakness is confirmed by wage data. Pay growth has been largely flat for over a year. In a truly hot labor market, employers would be forced to bid up wages to attract talent. The fact that they are not is the ultimate proof that the power lies with employers, not employees, and that the labor market is far weaker than advertised. The services sector, the supposed stronghold of the new economy, is suffering from the same illusion. Headline reports recently cheered that the services sector expands at the fastest pace in 8 months, with both the new orders and business activity indexes rising. This suggested a robust and resilient sector. But this good news contained a glaring contradiction. If business is booming, why are service sector companies still firing people? The report's own employment index remained in contraction, a reading below 50, for the fifth consecutive month. The puzzle is solved by looking at the one metric that matters for future planning: backlogs. The report showed that business backlogs are collapsing, remaining in deep contraction territory for the eighth consecutive month. This is the shadow data that reveals the truth. While new orders may have seen a temporary bump, the total pile of work available to businesses is shrinking and shrinking fast. Businesses are not hiring based on 1 month of new orders. They are firing based on 8 months of collapsing backlogs. They are cutting hours and jobs now because they can see the future and it is empty. This leaves the American business, particularly the small and mid sized ones, in an impossible squeeze. While demand is vanishing, their costs are exploding. The prices paid index, a measure of inflation for businesses, recently rose to a 3 year high. They are being squeezed by the rising costs of import duties, tariffs, and raw materials. To make matters worse, inventories across the economy are too high relative to the slowing pace of business activity. This sets the stage for a bleak holiday outlook. Businesses, particularly in retail, borrowed money at high interest rates to pay for tariffs and to stock up on inventory they expected to sell. They are now sitting on a mountain of product that a broke consumer base cannot afford to buy. If this inventory does not move during the holiday season, the consequences are predictable and dire. A wave of massive layoffs as these businesses are forced to liquidate and default. The positive headlines are a mirage. The reality is a trap closing in on both the American household and the American business. So, how do we wrap this up? What's the real cause of all this? It brings us back to that old political phrase. It's the debt stupid. The crisis flashing red from every fast food menu in America is not a temporary downturn or a simple case of corporate greed. The sticker shock that has priced the working class out of a hamburger is a symptom of a much deeper, more systemic disease, a multi decade crisis of debt and inflation. The root of the problem is not that McDonald's suddenly became expensive, but that the value of the dollar in the consumer's pocket has been deliberately and systemically destroyed. The ultimate culprit is not the franchise owner, but the Federal Reserve, which, through decades of inflationary policy and the creation of compound cumulative interest, Dar engineered an economy where household income cannot possibly keep pace with runaway costs. The gap between the 59-cent hamburger of collective memory and the $15 meal of today's reality is the entire story. It represents the chasm between what a worker earns and what things truly cost. This is the core problem. Median household income has not grown in a way that corresponds to the explosive Fed fueled run up in the price of every essential good, from housing and education to food and transportation. The system is built on a foundation of compound cumulative interest that functions as a silent, relentless tax on the poor and the middle class, transferring wealth upward while leveraging the futures of mom and pop to fund the present. This debt based system has created two fundamentally different paths of survival for corporations and for households. A household in economic terms is a small business model. It has assets, a home, a car, and operating expenses, a mortgage, food, energy, debt payments. A large corporation like Wendy's operates on the same principles, but with a crucial difference. When a corporation's liabilities exceed its assets, or when it has non performing divisions, it possesses a vital escape hatch. It can strategically sever its failing parts. Wendy's can close hundreds of its non performing restaurants to save the larger profitable entity. It can cut off the diseased limb to ensure the survival of the body. The mom and pop household has no such luxury. When a household's single asset, their home, becomes non performing because their liabilities, the mortgage, the credit card, the car loan, have exceeded their income, they cannot simply close that division. The household is the asset. They cannot sever the failing part because they are the failing part. Their only options are catastrophic, foreclosure, eviction, or bankruptcy. The options are all bad. This is the fundamental inequality of the debt system. Corporations are given mechanisms to shed their losses, while families are forced to be consumed by them. Therefore, the economic warnings coming from the drive through are the most honest signals we have. The positive headline data, the ADP reports, the ISM service sector prints are illusions, backward looking statistics that fail to capture the forward looking panic of a consumer on the edge. The real leading indicators are the ones that measure pain. The collapse in low income traffic at McDonald's, the emergency store closures at Wendy's, the desperation of a household facing a 50-year mortgage. The K shaped recession is not a distant academic theory. It is the lived reality of millions reported daily from the front lines of the American economy. The consumer base is cracking, and as it breaks apart, it threatens to bring the entire debt laden edifice of the stock market and the macroeconomy down with it.